Good afternoon, everyone. And thank you for your kind introduction. It is truly a privilege to have the opportunity to offer my thoughts today as part of Klyklyst Real Estate and Infrastructure Conference. I want to first thank the Klyklyst team for inviting me, and I would also like to offer a brief overview of my company and our real estate portfolio, and then sketch a few top-line trends that we are seeing in American market as well as New York in particular. Then I will offer an example of an opportunity in existing strategic location on the west side of Manhattan, a new area being developed by the name of Hudson Yard District. So about my company, the Moinian Group, we own and operate a diversified portfolio of assets across United States. We are one of the very few national real estate entities to develop and own and operate properties across every asset category, such as office, hotels, retail, condos, and rental apartments. We have high-profile assets in American leading cities, gateway cities, including New York City, Dallas, Texas, Los Angeles, California. Also, my company for the past 3 decades, the Moinian Group, has proudly been a pioneer in the development of emerging markets in New York, such as downtown financial district area, and now very involved in the west side of Manhattan, the new west side Hudson Yard District. We take a very, very tremendous pride in our work, and throughout our portfolio, we always focus on state-of-the-art design, amenities, environment, and sustainability. Speaking a little about US in general, on the national front, capital markets got off this year to a rocky start. In the early stages of the year, and sales volume went down. But the situation was stabilized somewhat, and the market has returned to a little bit more normal level right now. We are also seeing global investors remaining very confident to invest in US real estate, especially in gateway cities such as New York City, Los Angeles, and Washington, D.C. Also nationally, we are seeing debt becoming a bigger source of acquisition, financing, even with slightly increased interest rate right now. That means that the equity phase of the investment cycle may now give way to debt. New York City. Taking a look at what's going on top lane trains in New York City market, New York City has experienced good job growth over the past 5 years. Unemployment is down to 5%, and the industries expect New York City keeping and acting as a magnet to the young professionals that companies that are seeking to hire. Our tourism in New York City is going from 2015 of 55 million visitors this year to 60 million visitors. Apartment rentals are very difficult to find. Office building vacancy is hovering around 10% between Midtown and Downtown overall, which is an excellent rate of vacancy for both landlord and tenant. Retail is enjoying increasing in pricing and rent due to travelers and different aspects of the retail business on main shopping areas. On the investment side, we saw 2015 a record-breaking for the year of investment sales in New York City. The value of investment sales exceeded its pre-recession peak last year, reaching $75 billion in New York City in 2015. Though it is still too early for this year to tell whether that level can be sustained in 2016. In Manhattan, the prices of land has more than doubled since from 2009 to 2015. And the main reason of the price increase for land has been the scarcity of land in this limited land or island. And also in Manhattan, we saw a recent shift of market share in terms of tenants categories in commercial leasing of office space. From 2011 to 2014, the sector called TAMI, T-A-M-I, which stands for Technology, Advertising, Media, and Information, has been the outpacing in the rate of new leases in comparison to financial services. But in 2015, according to a report from Cushman and Wakefield, that has changed, and financial has taken a lead again in the office segment in New York City. Other segments in New York City that have been very, very successful the last 18 to 24 months have been anything to do with healthcare and education and alike. A big trend in office usage in New York City. Now let me give you an example of a great future opportunity that's available for investors and developers who like to think long term. About 20 years ago, my firm had a long-term vision. This was on Manhattan's West Side, and where we did a little, nobody did any development for very many decades. In 1993, we became a pioneer as we made our first purchase on 11th Avenue in New York City, an industrial building, and we converted it to a residential loft rental. That area is now called Hudson Yard District. We saw very soon the area's potential, and we committed to a long-term investment in the area. Our company made several land purchases in the West Side, and we continue to do so from 15 years ago. Over the period, we developed our trophy condominium buildings called Atelier, and now we have almost completed our largest development in New York City called Sky, which is 1,175 residential rental apartments, which today is the largest residential tower in New York City. Then it's our jewel, our next big development, 3 Hudson Boulevard, that we will start this month, is a 2 million square feet office building, which we are looking forward to develop. I'd like to especially thank the Katalyst team member again. I'd like to thank our very, very good friends at Katalyst, especially thanking my very, very good friend that invited me here to Israel, Major Admiral Eitan Ben Eliyahu, a good friend of mine, and ask if anyone has any questions so I can answer, and wish you a great, healthy summer.
There are 3 American companies that are now offering their bonds in Israel. And I want to ask you, what are the red flags that I have to search if I want to invest in those companies?
Okay. Israel public markets offers a great opportunity both for investors of the bonds as well as the sellers of the bonds, or we can call them the borrowers. I think if I was investing in any bonds, I would first try to dig in to our due diligence, see the background of the company, the background of the operator, their history, their success, their size, their commitment to the business, their loan-to-value structure, and see if they are going to develop a cash-flowing vehicle or a portfolio, or they have a different business plan. So I think today in America, clearly the record shows that cash flow is the winner among all other aspects of real estate. In our last 3 decades, we have always tried to build to cash flow, to keep as the multi-generational mentality, and try to look for good sources of financing and keep low amount of mortgage compared to the asset. And that's my due diligence. Also, I would say it wouldn't be a bad idea if you are investing serious money to take one of several enjoyable flights, go to United States, visit the buildings, visit the assets, talk to the tenants, see the neighborhoods. It's free, it's okay. You can, if you're investing, you might as well do that. And when we buy a building, we do the same thing. We look at the leases, we look at the building, we check the mechanicals, we check the structural, we check everything before we make an investment in the building. So the more due diligence, the better you are.
Hi. Ran Robinson, Global Economic Correspondent at Kälkkalist. How did the real estate sector change its way of doing business since the Great Recession, and what caused the resurgence in 2013?
Well, let me first congratulate Israel for not having the subprime problems. It was as bad as it could have gotten, and no fault of people that had nothing to do with it, but we were all contaminated with this issue, and it took relatively a very long time to get rid of it. I think I can explain the difference between then and now. The government of the United States has put a great amount of restrictions on banks. And banks, therefore, have put tremendous amount of restrictions on borrowers. And that has created a very, very unique discipline that does not allow the real estate developer or real estate buyer to build shadow assets, meaning office buildings that don't have leases, or many apartments that don't have tenants or buyers. So it limits the activity of getting to make decisions that does not make sense. It made the entire, that decision, that discipline made the entire real estate industry much more disciplined of how much they borrow, how are they going to show that they will give the money back to the bank. And it also at the same time created another avenue for unregulated lending, which are called mezzanine or preferred lending of that sort. So if you had a project or a building that you wanted to buy, and this was, for example, $100, you cannot get today more than $50 from the bank. And then if you want to borrow more, you will go and borrow from 50% to 75%, but the rate of that mortgage is almost double of the first 5. So that discipline has made the market in USA, especially in New York City, where the cost of construction is very high, a very, very disciplined, and we do not have much of inventory in anything. So if they build offices, they try to pre-lease offices. If they build apartment rental, they know what area to build them with certain programs to rent them. And if they have hotels, they will build hotels that have good management, good flag, good recognition, and that's what it is. So the big difference between pre-recession and today is the financing discipline that's in place right now.